Liability-driven investing, LDI, is a portfolio management approach that prioritizes meeting future liabilities rather than maximizing asset returns alone. Institutional investors such as pension funds, insurance companies, and endowments often face contractual obligations that must be satisfied at specific future dates. Consequently, portfolio construction begins with analyzing the characteristics of liabilities, including their timing, size, duration, and sensitivity to interest rate changes. The primary objective is to ensure that asset values and cash flows remain sufficient to meet obligations under a wide range of market conditions. Liability management therefore shifts the focus from traditional benchmark relative performance toward achieving funding objectives while controlling risks associated with changes in interest rates, asset values, and liability valuations. Managing a single liability requires constructing a portfolio whose value and interest rate sensitivity closely match those of the liability. The most common approach is immunization, which seeks to protect the funding status from changes in interest rates. Classical immunization requires that the present value of assets equals or exceeds the present value of liabilities and that asset duration matches liability duration. By satisfying these conditions, changes in interest rates should affect both assets and liabilities similarly, preserving the ability to meet future obligations. Portfolio managers also seek to minimize cash flow dispersion and manage convexity to reduce exposure to non-parallel yield curve shifts, thereby improving the effectiveness of the immunization strategy over time. Cash flow matching represents a more precise liability management strategy. Under this approach, portfolio cash inflows are structured to coincide exactly with expected liability payments. Managers often use high-quality bonds, particularly zero-coupon securities, whose maturities align with liability dates. Because each liability payment is matched by a corresponding asset cash flow, reinvestment risk and interest rate risk are substantially reduced. Cash flow matching provides a high degree of certainty regarding liability fulfillment, but may require significant capital and can be difficult to implement when liabilities are numerous, irregular, or long-dated. Consequently, this approach is most practical when liabilities are predictable and asset availability allows effective matching of future obligations. For institutions facing multiple liabilities over extended periods, managers often combine immunization and cash flow matching techniques. Multiple liability portfolios require consideration of the entire liability structure rather than a single future payment. Managers evaluate aggregate duration, convexity, and cash flow patterns while ensuring sufficient diversification and liquidity. The challenge becomes maintaining alignment between evolving liabilities and portfolio assets as market conditions change. Rebalancing may be necessary to preserve the desired relationship between assets and liabilities. In practice, institutions frequently employ sophisticated liability-driven frameworks that integrate actuarial assumptions, yield curve analysis, and risk management techniques to support long-term funding objectives while balancing return and risk considerations. A duration gap arises when the duration of assets differs from the duration of liabilities. This mismatch exposes the funding status to interest rate movements because asset and liability values respond differently when rates change. If liability duration exceeds asset duration, a decline in interest rates will generally increase the present value of liabilities more than the value of assets, worsening the funding position. Conversely, if asset duration exceeds liability duration, rising interest rates may create funding challenges. Managing duration gaps is therefore a central objective of liability-driven investing. Portfolio managers continuously monitor duration relationships and implement adjustments designed to maintain alignment between asset and liability sensitivities to interest rate changes. Several tools are available for managing duration gaps. Managers can alter portfolio duration by purchasing or selling bonds with different maturities, adjusting exposure to fixed income sectors, or employing derivatives such as interest rate futures and swaps. A receive fixed interest rate swap increases portfolio duration, whereas a pay fixed swap reduces duration. Futures contracts provide a flexible and cost-efficient means of modifying interest rate exposure without significantly changing underlying portfolio holdings. These instruments enable managers to respond rapidly to changes in liability characteristics or market conditions while minimizing transaction costs. Effective duration management requires careful analysis of both asset and liability sensitivities and an understanding of the instruments used to achieve desired exposures. Contingent immunization represents a hybrid strategy that combines active management with liability protection. Under this approach, the institution initially holds assets in excess of the amount required to immunize liabilities. As long as this surplus remains above a predetermined threshold, managers may actively pursue excess returns through tactical investment decisions. If the surplus declines to a critical level, the portfolio transitions to a fully immunized structure to protect the ability to meet liabilities. This strategy offers the potential for enhanced returns while preserving downside protection. However, success depends on accurate monitoring of funding status and timely implementation of immunization measures when funding conditions deteriorate. The key objective of liability management and duration gap control is to ensure that future obligations can be met regardless of changing market environments. Effective strategies require matching asset characteristics with liability requirements, controlling interest rate risk, and maintaining sufficient flexibility to respond to evolving conditions. Immunization, cash flow matching, contingent immunization, and derivative overlays each provide valuable tools for managing funding risk. Portfolio managers must evaluate the advantages and limitations of each approach in light of liability complexity, market opportunities, and institutional objectives.